Hello everyone and welcome to the ChartYourTrade.com free webinar series. Today we'll be discussing the current market and sector analysis for February 2014. I'm your host, Michael Lamott. I'm the founder of ChartYourTrade.com, and with us today is Adam Sarhan, who is the founder and CEO of FindLeadingStocks.com.
Look at the market outlook as of right now. The primary thesis is that the QE in general is a primary factor of the 5-year bull market. The bull market began in March of 2009. Next, in about 2 weeks, we turn 5 years for the bull market in March of 14. So understand the first theory in the broader picture that the bull market's aging. The typical bull market lasts anywhere between 3 and 6 years. Sometimes it goes a little bit longer, depending on how you want to really determine the bull market. But more or less, the easy money out, we believe, is behind us, and it'll get a little bit more tricky as we go forward, unless if we see a massive influx to the economy or if the Fed or some other global central bank really ramps up QE. Both events are possible. Whether or not they're probable is another story. But at this point in time, the short, intermediate, and long-term outlook remains bullish. Let's take a look at this chart. This is a monthly chart going back to 06. This is the S&P, and each one of these bars is a monthly chart, a monthly bar of action. And if you notice back here at the bottom, after the 08 crisis, QE1 began. The market surged 45%. QE1 ended, it fell 17. Bernanke's famous speech in Jackson Hole back in August of 10, you had QE2, which hinted the QE2, it effectively began. Market surged 36%, QE2 ends, it drops 22%. Then they announce Operation Twist, and then boom, it shoots up 37% with a little bit of a pullback of 11% right in here, somewhere in the beginning of first half of 12. But since then, you haven't had a pullback of more than 10%. QE3 was announced at the end of 2012, right up here. They actually doubled it up in December of 2012. If you remember, that's right before the fiscal cliff. That issue was resolved, and then boom, the market just took off and soared right up to new highs. This chart is actually a little bit older. The S&P is now at 1838 or somewhere in that area. But it's just the purpose of this chart is to show you which, without a shadow of a doubt, that QE has been a primary factor of the entire 5-year bull market. Now, the long-term outlook, let's take a look at this. This is very important for you to understand. The new super cycle began in April of 2013. Well, what's a super cycle? In simple terms, it's just a breakout of a long sideways consolidation. This is an annual chart of the SP 500, so each one of these bars represents 1 year. And if you notice, here's the roaring 1990s, the topped out March of 2000. You had the dot-com/9/11 crash, and then it bottomed in October of 02. The new bull market, you can make a case it was October of 02 or it was March of 03, began right around here, and then you had basically 5 years, interestingly enough, of bullish action. And then it topped out in October of 07. You had the housing and credit bubble during that time. The bubble burst, the financial crisis, we're all familiar. You had the March 08, the 2008 bear market, and then the March 09 bottom, which happened right around here. Then you've had the series of QEs, which we just showed you, and that led you all the way up until right here. About a year ago, in April of 2013, you had this happen, where you broke out above two important highs, the March 2000 high and then the October 2007 high. The second that happened, you're in uncharted territory for the S&P and the Dow and the Russell and the mid-caps as well. The NASDAQ, not quite, but we'll get there if the bull market continues. But as of right now, the S&P, by definition, broke out of a long 13-year sideways consolidation from the year 2000 all the way to year 2013. And since then, it's just gone, we're sitting right up here. So this is very, very healthy action. We're about 5 years into this bull market, and clearly this bull market is much stronger than this bull market right here. So we've seen these periods before. I recommend you go back and re-watch some of the old archives we have where we went through every single sideways consolidation in the S&P for the last 100 years. So we've seen, and the Dow as well, where you have these 13, 15, 18-year sideways consolidation areas, and which happened back here, and then you broke out and took off, followed by huge super cycles, which were the beginning of these big, massive, these type of big multi-year, decade-long plus rallies. So this 13-year sideways action, I would argue, is very, very healthy for the longer-term picture. And by definition, as long as we stay above this 1576, we're in new uncharted territory. Now the question becomes, which was asked at the last webinar, are we in year one of a bull market with the new super cycle, or are we 5 years in? Well, technically, we're in 5 years into this market, this bull market, so we are aging. But as long as we stay above that 1576 level, which was that old high, we have to be cognizant of the fact that any type of pullback into this area would be healthy within the longer term outlook. The intermediate term outlook is bullish. We have a lot to cover tonight, so we're going to go pretty fast through some of these slides, and it will be available on demand for you to review later. So let's take a look here. This is a daily chart of the S&P. This was, again, a little bit of an older chart from last month, and if you notice, every pullback was shallow in size and scope. The point of this chart is just to show you that even though at the time the market looked like it was getting in trouble, we saw it just again recently where we pulled in, which we'll go in a few slides and cover the latest pullback with the short-term outlook. But in general, every pullback, including what we just went through in January to February 5th, has been shallow in size and scope. Remember, we haven't seen a decline of over 10% since 2012. So that speaks in and of itself to the strength of this bull market. Let's take a look at the short-term outlook. Well, here's an updated chart of the S&P. It's a daily chart, so each one of these bars represents one day. Here's a little bit of an upward trend line, this dotted green line. And as you can see, the S&P, you had these vicious pullbacks. At the time they were vicious, but they're blips on the radar within a longer-term picture. But yet again, what I consider these pullbacks to be healthy, because what markets don't just go straight up. One of my a good buddy of mine has a line where he says, the market take the stairs up and the elevator down. So this is a classic case of taking the stairs up. You had a nice rally, pulls in a little bit, it undercut the 50. At the time, it looked awful. This was when Bernanke first hinted that the Fed's going to taper. And then the market shrugged it off, rallied back up, hit a new high, pulled in again, rallied, pulled in, and then just took off. And then it pulled in again, and then took off. This was that January, February low that we just saw. And each one of these pullbacks on a percent basis has been shallow, has been under 10%. This was 6.1%, this was 7.5%, and that was again, I think 5% pullback. Let's take a look at a chart. This was sent to FineLeadingStocks.com members on Thursday, February 6th, one day off the low. So again, this is a daily chart of the S&P. The white line is the 50-day moving average. And this is an annotated chart. A lot of what we're discussing tonight in the second half of the presentation will be the advanced entry points after we cover the market outlook. And part of the advanced entry points, this is going to be part two, so if you miss anything, to avoid repetition, a lot of it is covered in the first part. We recommend strongly to go back and watch the first part. But I'll do my best to answer any questions as we go. But the big point of the advanced entry, just so you understand the concept, is to get in ahead of the crowd. So this annotated chart, again, was sent one day after the low, and it's a little bit of a double bottom. It's an awkward pattern. Again, this is more of an art than an exact science. Be careful. A lot of you we've been told, have ingrained with you rules. I've got to do this. It's got to be this number of days. It's got to be this long, this deep, dot, dot, dot. What I've learned is to break free, and somewhat of a liberating experience is to realize that each person is different. Well, each chart, each pattern is different, and the rules, quote unquote, that have been ingrained into our psyches really have to just be unwound and realize that things are not. It's more of an art, not necessarily a science. 1 + 1 doesn't always equal 2 in the market. So that being said, this is somewhat of a sloppy double bottom, considered the classic longer double bottoms. But either way, the early entry point was right here. Now, in theory, it's very easy, especially, this was sent out in real time, but it was also, if you noticed, Thursday to February 6th was the day before the jobs report. So buying right there at that breakout is difficult. You're also below the 50, you're also below the middle of W, so not every single time you see an advanced entry point, you're going to pull the trigger and buy. But the idea is to show you that when it does make sense, it'll give you a much better edge, and now we're up here. So just keep that in mind as you move forward. Not every single advanced entry point that you see you have to buy, but the vast majority of the time it works out to your favor. So here's a chart of the SP 500. It goes back, it's a weekly chart, so each one of these bars is a week. It goes back to, see here, that 0.9% correction that we spoke about in 2012. And if you notice, what this was sent out in this week's Fine Leading Stocks report to our members, the idea that we want to, the bigger concept for the advanced entry points is that you want to buy leaders on weakness, not just strength. Step up and buy support. We'll get into that a lot more in depth as we go. But as of right now, it's just important to keep in mind that every pullback in the S&P has been shallow in size and scope. So here are the last few big pullbacks, and again, 6.1% from a few weeks ago, 7.5 from May of last year, and then 8.9 and 10.9. So the entire, for the last few years, we haven't really had a sustainable or any type of meaningful pullback. A lot of people, we didn't sell during this pullback. A lot of people change the labels, marketing correction, this, that, and the other thing, distribution days, and all this other fun stuff. We just keep it as simple as possible and do our best. The market's speaking. Our job is to listen. So if we've had stops, some of the stops were triggered, sure. I mean, we had stocks that were stopped out during this time, but we didn't blanket sell. And actually, we did some buying on the way back up and got in nice and early and have some nice profits in a lot of the positions at this point in time. But to get back on track here, keep in mind that we're taught, you're conditioned, every time the market pulls back, technical damage, the market's below the S&P, the 50-day moving average, which is the blue line. This is a weekly chart, so it equates with the 10-week, and then the 200-day moving average on a weekly chart would be the 40-week. They're roughly the same lines. So, at this point in time, you're below the 50, you're below the 200, you're below the 150, you're below the 100. It's looking awful every single one of these times, but if you step back, within an uptrend, when you're in a bull market, the idea is, what I've learned, is that you want to step up and buy weakness, not just strength. So in other words, buying this breakout or buying this breakout up here, buying any breakout in a bull market, which I'll show you in a few slides, works great, sure, fine and dandy when it just takes off. But to get that edge, that advanced entry point that we speak about, it's much better to step up and buy support. Now, will you buy the exact low? No, absolutely not. And you'd be foolish to think you will. We're not trying to pick the top or the bottom. Our goal is to capture the bulk of the move. We tell all our clients that the goal is to capture the bulk of the move. And, excuse me, you can do that by using these advanced entry points. Let's take a look at a few sectors that are in the market. The next few charts we're looking at were taken as of yesterday. So here's the XLF. The financials are very important. We always look at financials because it's a very good indicator or a proxy for the overall market. They used to say back 50 years ago, as goes GM, the rest goes the rest of the market. I'm a big believer of the financials and the rest of the sectors we're going to go through. It's not just one stock. Apple, for a few years ago, they used to be like Apple in the market, but it's really, I like to look at the overall picture. And each one of these sectors we're going to go through now, or industry groups, it's a piece of the overall puzzle. So if you look at these industry groups and they're acting healthy, which we'll get through in a second, you can see, well, maybe that, this pullback that we saw here is not the end of the world. It's 6.1%, but you've got healthy action underneath the surface. Leading stocks aren't breaking down. The sectors are acting fine. The market deserves the benefit of the doubt. Now let's take a look here. The financials, we just go back here to July and August of last year. You had a big run in the first half of 2013. You basically pulled back. You hit resistance twice at this level at $21. You pulled back again, found support at 50, and then you broke out right around here. Broke out, classic case, it pulled back, it retested the prior chart highs, found support, bounced off the 50, and that big up day was the end of December when the Fed at the Fed meeting. And then all of a sudden, the XLF jumps up, rallies, very strong gain, and now it's all the way up here. Well, what do you think is going to happen? We said it takes the stairs up and the elevator down. Well, you're very extended at this point. So, of course, it pulls back. And not just you, the XLF, excuse me, the S&P was extended and all the other major averages as well. So what happened was, invariably, you get this pocket between where the ETF is or where the market is and the 50. Almost like a magnet or an attraction. You see the 50-day moving average, lots of times, these, once they get extended, pull right back into it. What I've noticed is that support, it was resistance, now this line becomes support, is a better magnet. So lots of times people get frustrated, and we get a ton of emails and phone calls asking, hey Adam, what about the 50, what about this? The 50 is a great tool, I strongly recommend it, but understand that many times, which we'll get into later on in the program, the 50-day moving average in and of itself doesn't work well as a blind, long short type of a program. And we'll get into that a little bit later. So it's good. It's a very important area of support. Institutions use it. We all use it. We love it. But it's important to understand that it's not the be-all, end-all. It's one piece of the overall puzzle. It's one tool in your toolbox. So what happened here for the XLF, you pull back. It actually violated support, so it negated the breakout. The S&P was down here, and this thing's looking ugly. You had a 7.4% pullback. It finds support. And look at the distribution days or the heavy volume selling. Obviously, that's not Aunt Mary and Uncle Bob doing the selling, but you had a very similar pattern to the S&P. You could draw the downward trend line. You had a little bit of a double bottom pattern. It almost mirrors the S&P almost perfectly. And then what happens? It takes off. So, again, a 7.4% pullback within a broader uptrend isn't the end of the world. The transports, another very, very important group. This is the IYT for those of you that are following with the ETF. And this, it's a big triangle pattern that's forming. You have a little bit of the area of resistance down here. You have support up here. But more or less, it was a 7.6% pullback, but it didn't even touch this line of support. It touched it 3 times here. 1, 2, and then 3. And all I did was just extend it out to right here. So typically, you have to give this thing the bullish benefit of the doubt, even though it's below the 50, even though you're getting some wide and loose action, as long as it stays above support, and also way above these old chart highs. So keep that in mind as you shift your focus from, hey, listen, it negated the 50-day moving average. Maybe this breakout, you could say it was negated. Sure, but understand that it takes the stairs up. It's normal, and that's healthy. These pullbacks are healthy, as long as they're shallow in size and scope. Size meaning percent decline. It's a shallow percent decline. In other words, it doesn't fall 50%. And then scope meaning it lasts a matter of days or weeks, not months or even longer. Here's another one of the very important sectors we watched, the housing ETF, XHB. And here you had a little bit steeper pullback. You had an 8.8% pullback after finding resistance right up here in this zone of $32 to $33. Now, you kind of broke out here, sure. It negated the breakout, not a fan. It rallied right back up. But overall, stepping back, this is a daily chart of the housing market, the housing ETF. Here's a weekly chart. Look at the difference in the picture. This thing looks great. So you had a huge rally. It's paused for the last year or so. Meanwhile, the market's gone up. But this thing's perfectly healthy action. It's consolidating the gain. And what happened? Right now, you're sitting right below resistance after a huge uptrend. And actually, in the summer of 2012, I believe it was, so right around here, I was on CNBC with Maria, and I was bullish on housing. And everybody at the time was like, why are you bullish on housing? Because, first of all, the housing stocks had bottomed in Q4 of 11, and then on closing bell, I just made my case. I said, listen, look at the housing stocks, look what happened, and then boom, right there, all the way up here, we had that whole run. And these houses, it deserves the bullish benefit of the doubt. More importantly, it's acting fine. But when you look at something like this, the picture's a little bit too zoomed in. You look at the trees and you miss the forest. So bigger picture, even if it falls down to this area, I'm not going to say it's healthy, let's step up and buy it, but the way that the advanced entry signals work and the thinking is so important, is that you want to not catch a falling knife, but wait and see, expect it to pull back, even pull back into the moving averages, and then when it starts to rally, look to get back in. So don't bottom fish, don't buy it as it's falling, because it could fall all the way down here. Just keep in mind that it's normal and it's healthy for it to pull back into here. And if it doesn't and just breaks out, great, all the more power to us. Let's take a look at the Biotech ETF, IBB. So here are the these dotted trend lines, which is, there's two main components of the advanced entry and exit signals, which we'll get to next, tonight that we're going to discuss. The first is these downward trend lines within any pattern. And then the second is the moving averages. So I annotated this chart. We'll see it again later this evening. And it basically shows you a lot of these annotated, these advanced entry points based on the downward trend lines. So if you look back here, you had a breakout, short, breakout, and this is very, very strong action. And then it pulled in a little bit, broke the 50, and then it started bouncing. This is a daily chart, so this trend line starts here. It could go back even further. But then it found support 1, 2, and 3 times, and you had many breakouts since then. So basically the idea here is to say, okay, we're up here. What does that mean? Look at that pocket to the 50-day moving average, which is the white line. You got a big pocket. It could easily pull back and be perfectly fine, a stair type of a thing. So, or even pull back to the trend line and still be perfectly fine. So just keep that in mind as you move forward, that not every pullback is nasty or every pullback is scary. It's important to keep that in the broader context that these moves in general are normal and they're healthy. So let's take a look at the tech stocks. The QQQs. This is the NASDAQ 100. Okay, so what happened here? Same thing, very similar situation to the biotechs. You had a bullish breakout of the little triangle pattern. You had support 1, 2, and 3 times. Yeah, you broke the 50, but there's a difference between technical damage where in the short term and intermediate or longer term where it's just a normal pullback. You know, at this point in time, if you would have called me this day at the low and say, hey, Adam, are you bullish? I'm not going to lie to you and say, yeah, it was super bullish. We got to step up and buy. All I have to tell you is that in real time, as you start seeing these things happen, is that up here, which is right now more or less the case, you have to expect a pullback. So this day I wasn't bullish, but right around here I was getting a lot more. And then when you break out of this little downward trend line, which isn't drawn, and you're back above the 50, then yeah, definitely I'm bullish. Because again, you're not trying to catch the falling knife because it can keep going all the way down. The idea is just to expect a pullback. So instead of getting shaken out and scared every time the stock or the market pulls back, you have to understand that it's normal and it's healthy. Just like we go to bed at night, we have to rest. It's the same thing with these pullbacks. It's normal and it's healthy. I don't know anybody that can stay up for more than a day, if not two, and function at full capacity. If not three, they're really pushing it. The S&P futures were up 12 days in a row as of right now. Today was the first down day, so they deserve a pullback. And look at the Nasdaq, the QQQs here. It's up 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. Yesterday was up as well. So it's just one of those situations where keep in mind that it's a small change in your reference point, but it's important to understand that pullbacks are normal and healthy as long as they're shallow in size and scope.
Thank you all for watching, and we hope that you enjoyed Adam Sarhan's presentation. If you would like to try Adam's Buy Leading Stocks service, you can save 10% off of any membership level right now by visiting buyleadingstocks.com and entering discount code CYT when you check out. Thank you and have a great day.